Good day, fellow investors. We recently discussed our 9 stocks to buy from what we discussed here and shared on the YouTube channel. And there was a good question, okay, how to allocate my money, my portfolio to these positions? How much per stock and how to manage that portfolio allocation over time? Well, I have 3 portfolios. This is my personal portfolio. Then I have a model portfolio where we have 6 to 7 positions. This is the model one for the research platform. And then for ideas, for those that need more diversification, I have recently launched a diversified portfolio. And I think that diversification is a factor of knowledge. So the less knowledge you have, the more diversified you need to be. And Charlie Munger said, diversification is for those who don't know anything. Warren calls them know-nothing investors. If you're capable of figuring out something that will work better, you're just hurting yourself looking for 50 when 3 will suffice. And why diversification is only required when investors do not understand what they're doing. Warren Buffett. Diversification may preserve wealth, but concentration builds wealth. When it comes to allocation, it is also a factor of knowledge and experience. So why not put it in an investment age framework? If you haven't been investing for less than 10 years, I think it's better to be a little bit more diversified. Thus, you, let's say, lower the risk of your making mistakes, ignorance. So it's good to have 10, 15, 20, not more than 20. At some point, it simply doesn't matter. But 20, it's enough that you keep on learning and compounding that knowledge on businesses. If you have been investing between 10 and 20 years, then you can also already have a more concentrated portfolio of 5 to 10 positions, like we have the model portfolio on my research platform. And then if you have been investing more than 20 years, then you really know what is going on and how what fits you, then you likely have already more positions from the back, and then you can invest into the best option you have at that moment in time, like I'm doing now. Let's put this more into a perspective, and this is the YouTube value investing quadrant. There is also one like this on my research platform, and from these stocks that I discuss here on YouTube, this is the diversified portfolio, and these are the businesses I own there. When it comes to my diversified portfolio, this is my idea. You see, it's just 2,100 euros now, so it's more of an educational portfolio, but it helps to just play around with real money. 1% learning position, I don't think I have any there. 3%, it's a mid position that I say, okay, I already have there a possible 10% return, but it can go also lower. So when you are more diversified like this, you can play around with more positions and also assume a little bit more risk, because if you're happy buying if it goes lower, you can then increase to a full position, and then when the stock goes down, you buy here, you buy here. When it goes up, you can sell. You already have a profit. So I can already tell you here, this is a mid position. If there is oil crisis, then we can buy more. In the meantime, we get an 8% dividend yield. Nutrien, 4% dividend yield on the food cycle. American company, a little bit more expensive, but if it goes down on a really severe downturn, then I can check and then increase. Archer Daniel Midland's already good dividend there, will likely grow over time, has been growing for 50 years. I don't know if I will ever get it at 30, which would be a great margin of safety, so I buy it here, and then I can buy more if it, let's say, goes to 40 or 30. Here you have my prices paid. ADM is still around there. I think Nutrien is a little bit higher, 20%, but that is okay. And Rubis is at the line where I have paid. And this is something, I don't own any of the other companies. I will be checking Samsung now, especially earnings are coming on Friday. I'm filming this before Friday. So that's something that might be something interesting, because I also want to learn about the businesses going forward. So if you look at my portfolios, the key there is earnings and margin of safety, and then that leads me to allocation. When it comes to allocation, diversified portfolio, let's say that the return is 10%, but it can go lower, thus there is no real margin of safety. I can start with a position because I want to learn about the business, and then you can always buy something, it can double tomorrow, so at least you have something, and you usually have a dividend. If the returns are already much better with much less risk, then I'm starting to consider it for my model portfolio. 5, 6 positions, we have a legacy position, so that 6, 7 has been around already for almost 7 years. And then if there is something really good that I really like, then I put it into my Svenkalin personal portfolio, and that's the portfolio that I want to build over the next 20 years. So I buy maybe 3 great businesses in a decade, and over 2 decades I'll have a nice portfolio of a few positions. So it's not that I have one now. I think over the next 20 years I will keep on building that portfolio. So that's what I do. I have a list of 30 businesses I follow, and then you have to consider the driver of returns and the margin of safety, and those two components tell you, okay, this is better, this is not so good, this can get better, and that's how you allocate, let's say, your portfolio and your money to your portfolio. If we look a little bit here deeper, what am I owning, why and why not, there are some good risk and reward situations here, but if I look at the comparative table, for YouTube, you have a premium one on the research platform, then you see here we have the ratios: Apple expensive, S&P 500 expensive, gold miners expensive, Amazon, McDonald's a little bit better, Nestle, Nike. DHL, it's already interesting. There we have a, let's say, 9% return, but there is always the threat of European recessions, and in that worst case scenario, it could get a little bit cheaper, still 40% down. So I'm just watching. The dividend is already interesting, and I'm already at 15 positions in my diversified portfolio. So I'm not keen on adding just for adding, but it could be interesting. Then we have Petrobras, which is an oil play. Thus I'm waiting for an oil downturn to check it again if they survive that. ADM is already there, Berkshire is too expensive, Verizon, I simply don't like the debt, the interest rates game there, even if it already gets almost a 10% return. We have the dividend, 7%, if the dividend grows just 3% and stays at 7%, that's already a good return. If the interest rates go down, then you have a much better return, 14-13% per year. So that's already something interesting, but I don't know why I am not interested in owning everything. Kraft Heinz already looks good with a good dividend, but there are a few more businesses like that. And these brands, I don't know whether the moats will be there. JD Peet's also looks pretty good there. So maybe just keep following, and then over time I'll select something out of this. So there is no real rule. You have to see how much you know your businesses and then start building those portfolios brick by brick, laying a brick here, laying a brick here, margin of safety, prudence, driver of returns are earnings that go into dividends, value creation, and that's how you build a portfolio that will lead to your financial goals.